everyone, I'm Sim Gakhar, Life Insurance and Investments Advisor. Welcome to my 1 Minute Insurance Wisdom. My today's topic is on retirement planning. I'm not talking about regular retirement planning. Here, I'm going to give you some knowledge about how you can get income during retirement. What are the different sources of income? So number one, RRSPs. You all know that RRSP, while you were making money, a portion of 18% of your employment income you could put towards your RRSP where you did not pay a tax at that time. But when you will take out during your retirement, you will be paying tax at the lower tax bracket because that time your income will be lower. So I'm sure if you were a salaried employee, you had been taking out, and if not, then you don't have RRSPs. But if you had been taking out to save the tax in the front, then of course you'll be paying it in the end, but you have the income from there which you can use while you're retired. CPP, of course, if there's a contribution towards that, that will be a source of your income. OAS, depending upon old age security, you do get some retirement income from there. And now that's the main question which people ask me who are self-employed, who do not take a lot of income as salary, who take income as dividends, and dividends don't count towards RRSP. And they ask me, what will I do when I get retired? Can we do something about it? So yes, for the self-employed professionals, business owners, there's a very good way you can do retirement income planning, which is called IRP, Insured Retirement Planning. You can do it into the corporation. While you're making money, you can buy a whole life policy where you can pay the premium for the policy and the cash value of the policy continues to grow. You don't have to pay it all life. You can make it as a 10 pay, 15 pay, even 20 pay, depending upon the number of years you want to pay and your age at that time. Of course, if you're 60 years old, you don't want to make a 20 pay because you won't be making money till age 80. But if you are 30 years old, 40 years old, 50 years old, depending upon your age, you can buy a shortened pay policy. And then policy has a cash value which will grow tax-free because it's inside the policy. And then when you are retired, at that time, you can draw the income from the policy, from the corporately owned policy. Now, it again depends how you draw the income. There are different ways to draw the income. You can draw the income by taking it as a loan, which you can pay the interest on, and or you can capitalize the interest and you can borrow the money from the insurance company, or you can take the policy by surrendering the policy. There are different ways you can draw the income from the policy, but it can really fund your retirement, and that's a very good way to plan your retirement for self-employed professionals and business owners. Feel free to call me and I can help you structure one for yourself, for your corporation, where your corporation will pay for it. It's going to be a cheaper dollar that you're going to be paying from your retained earnings, and everything will grow tax-free. I'm Sim Gakhar, 647-889-7290. Thank you.